even though we can look at the history of these alternatives and see that they have delivered on their promise for the most part, they have gone up over time. They've been uncorrelated to stocks and bonds. Many provide very attractive returns during those bear markets for stocks and bonds. They march to the beat of their own drum. And that's why we hired them. But that's often why allocators are fired by their clients, because when stocks are going up, maybe they're not keeping up. And it leads to friction and tough conversations and a real behavioral issue. So that's why what we tend to see when we look at the numbers is that these wonderful diversifying assets don't really end up in client portfolios. And when you look at the category returns, the investment return is quite good, but the investor return is quite bad. There's usually a large performance gap there because people end up trying to market time them. They get in at the wrong times, and it's hard for them to hold it structurally. Return stacking tries to solve that by saying, what if instead of making this an either or decision, it's a yes and decision? So just as a basic example, every return stacked ETF that we offer, when you give us $1, we're going to give you $1 of either core stocks and bonds plus $1 of exposure to some diversifying asset class or strategy. And so what that means is you no longer have to make room in your portfolio. If you were to say, sell some stocks and then buy a fund that gives you stocks plus managed futures, you're getting that stock exposure back and you're getting that diversifier layered on top of the portfolio. And so it totally changes the way in which people can think about adding diversifiers. It's no longer this either or, it's a yes and decision.